Dan, take it away.
All right, thank you, Madam Chair. And Jared, it looks like you've got Lauren up here with us, so thank you for doing that as well. So this is item 8C, which is the companion item to 8B, this one being done by your investment team, the trust level review by your investment team. So let's see, can we get the presentation up? All right, thank you. So as mentioned, this item is one of two semi-annual trust level reviews we conduct each year. The goal of this item is to provide the committee with information about the portfolios and their performance, some of the key business initiatives designed to support and enhance our investment program, and then some of the market and economic conditions within which we manage the portfolio. So the item has three main parts. I'll start by giving us an overview of the risk positioning and performance of the various trusts. From there, Arnie Phillips will take us through some of the key business and operational updates, and then we'll finish with Lauren Rossborough-Watt providing an update on global markets and economic conditions. So with that, let's dig right in. Can we go to the next slide, please? So let's start with the positioning of the Public Employees Retirement Fund, or the PERF, and I would say that there are three main takeaways here. First, the PERF's risk is dominated by assets sensitive to economic and corporate earnings growth. Based on our quantitative modeling, 95% of the risk in the PERF comes from this growth exposure. And this is one of the reasons for the thoughtful work that Sterling and his team are doing as we move through the ALM process to check our appetite for this risk exposure. The second key theme is that deploying capital at scale into the private assets while maintaining our high underwriting standard is a perennial challenge given our size. Now, this is a challenge that it's critical that we meet and one we're focused on, given how accretive private assets are to fund returns, but it is a challenge. And currently, this has resulted in the PERF being underweight private equity by about 1% and underweight to real assets by 3%. And the third main takeaway is that current actionable tracking error for the PERF is 26 basis points. Now, please recall our item in November where Michael Krim joined us and walked us through what we mean by actionable tracking error, meaning the deliberate, controllable departures from the benchmark undertaken by staff. Now, 26 basis points, or roughly 0.25%, is a relatively modest level of active risk, especially when compared to the total active risk of the portfolio of 1.1% and total planned volatility of 11.5%. And this actionable tracking error reflects the impact of active strategies across the public markets and portfolio exposures. So as requested by the committee, and as a result of the November discussion, we do plan to propose some changes to the total fund investment policy in June to update the tracking error definition and limit. And these changes will be intended to really do two main things as requested. First, to provide a more sensible governance metric for the committee to use when measuring active risk taken by management. And second, to avoid any disincentives to deploy capital into the private markets that we all believe are so critical in our aim to achieve absolute returns on the assets. Next slide, please. So on the next slide, we're looking at the performance of the PERF and most of the affiliate funds. As we know from our investment beliefs, the returns of the various trusts are driven predominantly by their respective strategic asset allocations. And I would say that in general, performance of the various trusts was roughly in line with expectations, with one main exception, and that being the underperformance of the relative to the benchmark of the PERF across many time periods. And that takes us to the next slide, please. And on this slide, we can see the returns for the various programs and across various time periods for the PERF, and to get a sense of what drove the PERF's overall performance. Now, given our nature as a long-term investor, I'll lead with a 10-year number, which now stands at 8.4% and is above our 7% assumed rate of return. Now, we should bear in mind that this number reflects a strong run-up in equity markets toward the end of 2020, but it is encouraging. Now, since this is an annual program review where we cover calendar year results, I'll move us to the one-year numbers, just reminding us to keep in mind that the one-year number we need to keep in context given our nature as a long-term investor, or true nature as a long-term investor. And in terms of absolute return, during calendar year 2020, the PERF earned a 12.4% rate of return. And this return came primarily from the equity asset classes, as expected, given our risk analysis that we discussed on the first slide. Public equity returned 13.7%, and private equity returned 12.3%. and the two together were the primary driver of returns. In addition, though, our income assets also had a very strong absolute return, earning 11.7%, with particularly strong performance from the Treasury segment. And while absolute returns for the PERF were quite strong, excess returns are more challenged, candidly, with calendar year returns reflecting underperformance of 4 basis points relative to the benchmark. This underperformance for the PERF was driven by relative underperformance in the private markets, offset by positive excess return in the public markets, primarily in the fixed income asset class, which continues to deliver very strong active returns across all time periods. So that covers the review of risk and performance. And with that, I'll turn it over to Arnie to take us through some business and operational highlights. Arnie, over to you.
Thank you, Dan. So today I'm going to share some reporting enhancements we've done, take some time to go through our operating model, and end with some major accomplishments from the last year and some future initiatives. So next slide, please. So Dan gave a performance overview, and I want to highlight some performance reporting enhancements our investment risk and performance group, or IRP, made to reflect our one team, one fund approach and improve our visibility of investment and financing activities at the total fund level. The reporting changes are designed to improve transparency and to align with actually how we're managing the assets from a top-down total fund portfolio construction process. A couple of highlights I would like to note. First off, and very importantly, the economic exposure of the entire PERF has not changed in this new reporting format. The low liquidity enhanced return, or LLER, is now shown as a distinct total fund program. Before the assets and the performance were embedded in both the global fixed income and global equity asset classes, so this will provide a clearer view of what's going on in LLER. And total fund financing activities are now shown explicitly at the total fund level. This report now aligns with the total fund focus of the investment office, reports along the line of how the assets are managed, and is designed to provide greater clarity and transparency on our liquidity and leverage activities. Next page, please. This slide depicts our operating model. It was originally known for folks that have been around a while as the targeted operating model, and has been utilized by the investment office since 2011 to identify and manage operational risk. Our investment controls and operation risk team, or ICOR, manages the process and reports quarterly to the operating committee, of which Dan and I are both members. Risks have been allocated to 24 different classifications with a weighted average risk level of 4, reflecting a mature operational control framework with the majority of functions and activities on average at the low to medium risk level. However, the reality is that we will never perfect any of these classifications, but the goal is to constantly improve. Next page, please. So on this page, we'll go through some of the accomplishments of the past year, and I'll end with some of the things we'll be working on going forward. So as all of us know, the last year we've been working remotely, and it's actually been a great success and really a testament to the collaboration with many teams in the organization, including the executive team, our HR folks, our information and technology team. And the reality is the investment office could not have gone 100% virtual in a matter of days and operated as efficiently as we had if we had to do it alone. So work from home has been a really big success, and everybody that was a part of it deserves a big thank you. Our liquidity and leverage effort in the last couple of years actually has been an investment focus. And we've spoken in the past about our liquidity dashboard, and it remains a critical component that allows us to effectively manage our liquidity and leverage positions at the total fund level. The entire office is really focused on and improving in the area of technology and data. It's critical to any investment organization, and we are no different. Our trading systems, compliance engines, business continuity plans, risk and performance platforms are all intertwined and have benefited from an improved data and technology focus. But this is also an area with large performance improvement opportunities. Finally, we have focused on the people side of our business with a communication focus on the one team, one fund culture. Of course, now being done largely virtually. Dan and I lead regular webcasts with the investment office. We now have a monthly investment newsletter. Dan or I will send out a weekly update email recapping the week's key topics. And we've even been regularly meeting with small groups of, call it 10 or so folks, to just talk about any topic on their mind and help answer what's going on in the office. And all of these efforts have been led by our great communications team, led by Don Ponce, Shazia Dawood, Shannon Hogenbosch, Tara Akari, and Tiffany Harder. Dan and I just greatly appreciate their efforts to help us improve the communication with our team. As for the future, well, we talked about it today, but the asset liability management cycle will continue to be a big focus for the next year. Obviously, extremely important work as we strive to meet the 7% return target. As it relates to that 7% target, we'll continue to improve our capabilities and our ability to deploy dollars into private assets. I mentioned it in the accomplishment side, but technology and data strategies are going to remain important to increase our chances of success. And finally, we will continue to focus on our people. The enterprise engagement survey has given us a lot of helpful information that we are going to use to focus and improve the office going forward. We are launching an informal mentoring program. And finally, we recognize that the development of our people is vitally important to our goals and will be a continuous effort. So we intend to relaunch our Education and Training Advisory Committee to focus on development opportunities for our staff. With that, I'll stop there and hand it over to Lauren for a quick economic update.
Thanks, Romani. Hello, everyone. So on the next slide, slide 8, when we come every March, we talk around the calendar year 2020, and Tom spoke around the near-term macro situation. So today I'm going to focus some more on the bigger trends. So as we all know, 2020 moves in the economy were outsized. Let's use the US as an example. In Q2 2020, the US collapsed 31% at an annualized pace after a 5% decline in Q1. But it then bounced back 33% in Q3 and then another 4% into Q4. And you can see on the chart there on the left-hand side, the bar chart, the end of the year, the December 2020 figures compared to a year prior were down 3.5%. Now, in fact, the numbers have been revised higher from there. The US economy is a mere 2.4% weaker than December 2019. But in a historical context, the intra-2020 drop in GDP would have been well off the left-hand side of that chart. But because of the speed of the turnaround, the annual return was not significantly outsized. These types of moves have been global. But for the vast majority of countries, their economies are within 10% of pre-pandemic levels within 6 months. And the IMF estimates that world growth will be around 3.5% weaker at the end of 2020 than at the beginning of the pandemic. And those numbers are starting to feed through or be published as we speak. If we look forward, the OECD recently revised up its world expectations, partially on the back of the American Rescue Plan. It anticipates global growth to reach pre-pandemic levels now by mid-2021. Now, you'll recall last year we spoke around expectations, market expectations for GDP to reach pre-pandemic levels sometime at the end of 2021. That's certainly been pulled forward. The current macro environment has direct implications for risk. And when I talk about risk, I'm referring to a range of outcomes around an expected return. And Sterling Gunn today spoke in detail around risk and about return. So I sort of want to put that into the context of the macroeconomy and how that fits within a risk framework. One notable feature of the economic downturn that we saw has been the type of shock we experienced. So the chart there on the right-hand side of slide 8 shows the annual size of the falls in US activity and corresponding recessions. Over the past 40 years, recessions have typically been the result of a period of extended growth, an overextension in credit, and then a retracement in demand. Whereas this recession was the result of an external shock, culminating in a drop in supply and demand. So not only is this type of recession different, but as mentioned earlier, the size, the duration, and the speed. So the recession seems unusual or more volatile. And in a risk framework that suggests the expected distribution of potential future outcomes may also be wider. We can see how households view the future by way of the sharp rise in precautionary savings. So in the US, the personal savings rate peaked at 33% in April 2020. It remains elevated today at 20%, and part of that is the inability to go out retail shopping, as the board spoke around earlier. But nonetheless, based on the levels of unemployment we see in the US economy, precautionary savings still remain relatively elevated. So in the most basic sense, savings reveals our preference for the today over the future. So when times are good, we prefer current consumption over future consumption. But if we have low transparency over the future about how things may pan out, we save more. So our perception of risk has changed. Now, of course, policy support, both monetary policy and fiscal policy, are an attempt to temporarily counter these risks. All right. And these policy responses are broadly an extension of the type of support undertaken following the 2008 recession. Quantitative easing is a prime example of that. So from a risk perspective, policy support has reduced some of the downside to economic outcomes, and it's also mitigated systemic risks to the economy. The assumed temporary nature of policy support implicitly assumes that the relationships between economic indicators are unchanged. We've simply been hit with an unusual shock. But there is a growing debate, and we spoke about this in the last board meeting, about whether the underlying process is indeed known. So if the behavior of the economy is not fully understood, then we may see more events that seem unusual compared to recent history. So the question then is, and this is an open question, has the pandemic embedded changes in policy responses that began back in 2008, i.e. is the world a different place? Or will the pandemic be, when we look back, a large event, but somewhat standalone as the global economy transitions back to something close to normal? And there are other aspects where the policy response is linked to the macroeconomy and to risk. And once again, these remain open questions. We're posing a lot of questions today. For example, if investors anticipate that central banks will do what it takes, as it were, using ECB language, will this change investors' behavior towards risk in the future? I.e., so has the price of risk changed? Or indeed, or is there now some asymmetry in the distribution of future expected returns? Central banks are purchasing assets and are reducing high-frequency volatility as a result. Could this mean an increase in future macroeconomic volatility, i.e., could it increase the probability of bigger booms and bigger busts? And another question, what might happen to the relationship between asset class returns over time, or the covariance of returns, if one or more asset class has greater support by the central bank or the fiscal authority? And as I said, these are open questions. They're ones that investors and ourselves are going to be grappling with in the years ahead. So if I was to summarize, 2020 was certainly exceptional in our living history. And I've attempted to illustrate today how we think about risk and uncertainty in the context of the macroeconomic environment. And as always with the macroeconomy, we don't know the future, but we have an idea of some of the questions that we should be asking. And we do that to ensure the resilience and the performance of the fund, to ensure it into the future. That's it for my prepared remarks. Back to you, Dan.
Thank you, Lauren. Madam Chair, that concludes our prepared remarks. We're happy to take any questions that you or the committee may have.
Thank you, Dan. Those were, I really appreciate all of those presentations. And I am not seeing, and correct me if I'm wrong, anybody, I'm not seeing any questions. So it looks like we are. I'm sorry.
I see Henry. I see Henry with a.
Oh, Henry.
looking for one.
Okay. Well.
Yeah, thanks. I could not. The slide presentation was covering up my chat box. I couldn't hit it. So, yeah, just a question on the in terms of the equity market drawdowns over from a historical point of view. And then I was just looking at the financial crisis in 2008 and then the pandemic COVID-19 that we experienced. And the drawdown was significantly less than the 2008 crisis. So my question is, was it because of the actions we took after the 2008 crisis that mitigated the drawdown, or is it just that the COVID-19 wasn't as bad?
Yeah, thank you for the question, Mr. Jones. And my recollection is it's a little bit of both, but I'm guessing that you're looking at slide 13 in the appendix that shows a smaller pull down.
Yes.
One thing to know is that those are monthly numbers. So recall that the pandemic's drawdown really started late February, really drew down to March 23rd, and then bounced back up. So what you're seeing there is kind of March 1st to March 30th when we had already recovered a little bit. Whereas during the financial crisis, it was much more extended, and that's why you're seeing it down and stay down, which speaks to the second part of your question, which was the response by the authorities, both fiscal and monetary policy, different? And the answer is yes. It was much larger and much faster in response to the crisis. The pandemic. That with the crisis, there was a lot of things that were fairly new that were untested. All of those were in place with the pandemic, and so as soon as the pandemic broke out, the authorities, both fiscal and monetary, were able to react in size and quickly.
Okay, that answers my question. Thank you, Dan.
Absolutely.
Great question, Henry. I do have another question from Controller Yee.
Thank you, Madam Chair. I just had a question on page, actually, I think it's page 264 on the iPad about the global equity portfolio. Just wanted to find out why the factor-weighted portion of the portfolio recovered more slowly than the cap-weighted segment.
Thank you for the question, Madam Controller. The answer is really it's a different construct of the equity market. So recall that the the cap-weighted is really just kind of a standard harvesting of the equity risk premium. The factor-weighted was put into the portfolio to have some characteristics that are different from that cap-weighted. One of which is being somewhat more defensive. So it experienced less drawdown. If my recollection serves, the cap-weighted portfolio was down over 30%, whereas factor-weighted was only down, not only, but it was down maybe 25, 26%. But then the converse was also the case, that when the cap-weighted bounced back as quickly as it did, the factor-weighted bounced back more slowly.
I see. Okay. And then just a question with respect to the staff. Given the limited ability to travel, has that presented any challenges in terms of conducting the due diligence on any of our potential investments, particularly in the private asset classes?
I guess I would say, yes and no. I have been just incredibly happy with how well the team, and Arnie spoke to it, the technology team under Kristen Farland's leadership, the entire organization under Marcy's leadership really pivoted quickly and was able to stay productive. And I have been just really proud and impressed by how the team has been able to just figure out alternate ways to do things. That said, when it comes to, say, something like operational due diligence that happens within ICOR on Kevin Hurst's team, it's hard to really kick the tires when you're not present. So certainly we're doing it virtually. Certainly we definitely believe the risks are controlled. But I think that there will be a balance. And once it's safe and we can travel again, I do think that, speaking to what the Makita folks and David Glickman said on the real estate, I do think there will be some pent up demand for travel, and there will be some business travel that'll be needed also.
Yeah.
And Dan, don't you think generally we've been cautious of new relationships in this period of time, just because we can't do the appropriate due diligence under normal circumstances? So, just leveraging our existing relationships over the last year has really been the course.
That's great.
Agreed.
Yeah.
I would say leveraging. We are trying to underwrite new relationships, knowing that we need them both in the private debt space and then also in the private equity space. In terms of better diversifying the private equity portfolio. But yes, it's definitely the case that we've really leveraged our relationships to try to do sort of indirect due diligence, go with highly reputable organizations that we think we have some intelligence on, because that has been probably where the challenge has been presented, and certainly we think we've controlled the risks. But I do think that it will probably be a snapback in travel when the time comes.
Great. Okay, appreciate that. Thank you. Just great work from everyone. By everyone. Thank you.
Thank you. Thank you, Lauren. Thank you, Arnie. We're moving on to 8D, proxy voting. I'll hand it to you, Dan. I imagine you're handing it to Ann.
Terrific. We actually have, I think, I don't see Ann yet. If we could get Ann Simpson forward, that would be great. And we have Samiso with us to lead this one. And I do see that we've got Samiso. Let me get to my notes very quickly. So yeah, this takes us to item 8D, which is where we'll give an update on our proxy voting and corporate engagements that happened. As we talked about it earlier, proxy voting and corporate engagements are really a key part of our investment strategy. So with the 2021 proxy season approaching, we wanted to take a moment to both share our priorities for this coming proxy season, but then also share some of our outcomes from the 2020 proxy season. So with that, I'll turn it over to Samiso to lead us off, and we'll take it from there. Samiso, over to you.
Thanks, Samiso.
Thank you, Dan. Madam Chair, good afternoon. Members of the Investment Committee, Samiso is the CalPERS staff. If we could have the presentation up, please. I'm just waiting for the slides to be put up on the so I can walk you through that. I don't know whether we're having technical issues with that or. Well, I can proceed without the slides. I'm assuming the board members you have the slides on your iPad, so I can proceed without the slides up on the. But if you look on slide 2, in terms of the looking forward to the 2021 proxy season outlook, really the things that are there are things that we have seen before, because really we are still sticking to the 5-year sustainable investment strategic plan, which the investment committee adopted in August 2016. As you can see, really the 4 items that I put out there, those are the core activities that we're actually dealing with and looking at. It doesn't mean those are the only things that we're doing. We actually have a lot of work under this work stream, but really corporate board diversity and climate action, those 2 are in our sustainable investments strategic plan. And then executive compensation is something which really is about alignment of interest, which is really, really important to us as an investor. And then investor rights, that's something which gives us the ability to hold boards accountable. And in there, I list 2 things, which is proxy access and majority vote for director elections. And those are things that CalPERS has been pushing companies to adopt and even advocating in terms of the regulators and so forth to have those in place, because those are the only ways that gives us the ability to hold boards accountable. If we move on to the next slide, which is the one that looks at the 2020 proxy season outcomes. So if you look at that slide, really, let me see, I'll move on my slides as well. If you look at that slide, really, all we're talking about here is about board accountability. And this is really important. Again, board accountability forms the foundation of what we do here at CalPERS. When we're investing in these companies, we're investing in companies because we're trying to earn a return. And with that return, because we invest in so many companies, we can't be sitting on those boards at all those companies with other people sitting on boards, and we have to hold them accountable for that. So in terms of those items, really starting with enhanced compensation, if you look on compensation, we voted against 51% of say on pay plans. But these say on pay plans, again, these are advisory votes. They are not binding to companies. Even if you vote against them, the company can decide to ignore that. So what we did there is that we actually started voting against compensation committee members. And as you can see, we voted against we voted against 3,400 compensation committee members this past proxy season. This again is to hold them accountable for that misalignment between pay and performance. And we didn't just stop there from voting against the compensation committee members. We then wrote to these companies, to the compensation committee chairs, as well as board chairs, to say we wanted to have meetings with them to explain why we voted against them. So we wanted absolute transparency in this issue while we're holding them accountable. The second thing is on the now we have the slide. So on slide 3, the improvement on corporate board diversity. So again, here, if you look at the work that we have done, 65% of the companies that we engaged since 2017 have added elements of board diversity that they didn't have. And going back to the issue of accountability, as you can see, we voted against over 200 directors where our engagements had not been constructive. So really, the number of votes against directors, as you can see, have been trending downwards. So if you look at 2018, we voted against 468 directors on corporate board diversity, and now the number is more than, it's just less than half that. So a decrease in this number is a positive thing. It means that companies are actually adding diverse candidates to their boards. And then on climate change, I just want to spend a moment to talk about this, because this shows the value of engagements. And just to give you the timeline, and we use that case in point in ExxonMobil. And in May 2020 at the AGM, we actually voted against members of the board who sit on the Public Issues and Contributions Committee, which is the committee that oversees climate change at ExxonMobil. We voted against them because they're not disclosing Scope 3 emissions. And then in August 2020, we actually followed that up by filing a shareholder proposal asking the company that it actually disclose the Scope 3 emissions. So this proposal was supposed to be voted at the company's AGM in May this year. And at the start of this year in January, the companies disclosed Scope 3 emissions for the first time ever. So again, this shows our approach in terms of this work. We engage privately and confidentially. If we don't see any results, we use our investor rights to hold boards accountable by voting against them. And if that doesn't help, we also file shareholder proposal to get the company to do some of the things that we're asking for. So I won't go into the appendix. There's a lot more information in the appendix, including slide 12, which is the last slide, which actually includes the links to our website. Our website is a lot more information on this item and all the things that we're actually doing. So I'll stop here and we'll take any questions.
Sure. Samiso, thank you very much. Hold on one second. I'm trying to get, oh, there it is. All my questions up. So first of all, thank you very much, Samiso. I had a question on the ExxonMobil withdrawing the shareholder proposal. So they disclose their Scope 3 emissions. Does that guarantee they're going to continue to do that?
They will continue to do the disclosure on an annual basis. And they actually came out with an 8K filing in December 2020 to say that they will start disclosing that. And this has been an issue. It was an issue for a long time, which a lot of investors were raising with the company, and the company wasn't willing to disclose those emissions.
Okay, and what are you looking forward to? I mean, it looks like we do our proxy voting kind of on the same things. The company amount, I mean, the amount of proxies we file, I think, what was it on the corporate board diversity is going down. So I think that's a really good thing, but at the same time, I feel like that's not enough. And I think I've asked this before, if we could get, and I know this is a hard one, but if we can get statistics for some of these corporations and their racial makeup, and I know this is difficult, but I think it's important that we do more for the board diversity. I mean, it can't just be board diversity, right? We also have to be loaning to diverse managers. We have to be making sure those corporations are promoting folks throughout their corporation. So is there anything, I know you're talking specifically about proxy voting, but is there anything we do on that?
Yeah, there is. I'll let Anne, I see Anne has a hand up. I'll let her speak first, and then I'll add if there's anything else that I need to add.
Okay, thank you.
No, thank you very much for the question, Chair, and thank you, Samiso, for the presentation of all this wonderful work that you lead. It's so important. The board will recall that we have 3 channels in our strategy for sustainable investment, one of which is engagement, and that's this tremendous work that Samiso has just presented. The second is integration, and that's you're going to hear more about this when Brad and Marlene present to you the diversity, equity, and inclusion framework, which covers our investment strategy for integration. But the third piece, really important, is advocacy. Because at the moment, we simply don't have the data, the corporate reporting that enables us to track what's really going on with diversity and inclusion. And I think you will have seen James Andrus gave testimony 2 weeks ago to a subcommittee of the House Financial Services Committee on this. And CalPERS is going back on Thursday to give another round of testimony specifically on the issue of data around diversity and inclusion. And we've been in this miserable situation of looking at people's names, trying to peer into photographs. There's really not an acceptable way to understand the talent that you have on the board. But we've also been at the forefront through the SEC and also internationally in arguing that we don't just need diversity and inclusion being reported on at the level of the board. We need this right through the company. And also health and safety, and also working conditions, and also contractual status, because we're not going to get to the inclusion part of this agenda unless we understand much more about the economic conditions. You know, companies say our people are our greatest asset. Well, if we're the investors in those companies, then we really need to understand not just the asset that people are in the company, but also understand some of the risks. And COVID has made that brutally clear. So I think these 3 channels, all supported by partnerships, really give us the full scope of the approach. But today we're focusing on the proxy voting bit, of course.
I appreciate that, Anna. And I wanted to also say congratulations to James on his testimony. Great job. I did look at it, and he's going back, so awesome. So we've got more work to do in front of Congress. That's awesome.
Well, I was gonna add, Madam Chair, if you don't mind, that there is, if a recent bill was introduced in the Senate called Improving Corporate Governance Through Diversity Act of 2021 by Senator Bob Menendez. And this is actually, is the same bill which actually passed the House in 2019, which got bipartisan support in the House, and it will require companies to disclose the racial, gender, ethnic, and veteran status of their board members. So if this bill goes through, then again, this will provide a tailwind in terms of getting that data that we're looking for. So it's the same bill that passed the House in 2019, is coming from the Senate, and if it passes the Senate, then it will most likely pass the House because it got bipartisan support.
That's fantastic. Well, it got bipartisan support in the House in 19?
It did.
Oh.
Yeah. And CalPERS has supported this. Just say CalPERS is on the record for the House and for the Senate in that arena. Thanks, Samiso.
Thank you very much, both of you. Also, I am not sure, Rob, did you want to state what you wrote, or did you want to leave it there? I don't know if he heard me.
I heard you. I don't know if you can hear me or not, but I just wanted to say that I saw Samiso on a panel at the CII conference, a virtual conference this last week, and he did a great job representing CalPERS. So I just wanted to put that out there for everyone. Thank you.
Great job. Thank you, Samiso.
Thank you.
Stacy.
Thank you, Madam Chair. Samiso, this is very helpful to hear, so a great overview. I want to know if we're looking at the correlation of investment or company performance along with board diversity or C-suite diversity. I know there's not a lot of data out there, and you probably have some answers to this too, but I'm wondering if we're tracking this or what initiatives we're taking right now.
I can say something about Series 3, Samiso, if that's helpful. So yes, you're absolutely right. We're caught in a trap. We have an insight and some evidence that human capital management really matters. That's in CalPERS investment beliefs. And also specifically the diversity and inclusion are markers for performance, high performance and also low, but we don't have consistent data. So we did, as part of the Sustainable Investment Research Initiative, round 1, round 2, review all the evidence that was out there. However, with the focus on racial equity and inclusion coming to the fore and us having even less by way of information, we've issued a request for information to get research proposals in, both on this question, but also an emerging issue in climate change, which is looking at what we can learn from research around the question of capital allocation. And I know that's something you've been interested in. So we've had about just under 20 proposals in, and Nelson de Conceição, who leads our research team in this arena, we're going to sit down to review these, and we'll be commissioning a new round of research. Because, you know, we've got these broad brush conclusions about the impact on performance, but we need to drill down into what specifically is going to make the difference. Thank you. I don't know if Samiso wanted to add anything to that.
So there is a growing body of evidence. I mean, MSCI has done some studies. A lot of the studies are around gender because that's the data that's available, and it does look, some of the studies look both at the C-suite as well as the board, and there is correlation. And obviously, you know, correlation is not causation, but that correlation shows that companies which are diverse tend to do better operationally, financially, you know, in terms of risk taking, in terms of investment in innovation, R&D, and all those factors. So the data showing the correlation is there. Maybe it's just more focused on, you know, on gender because that's the data that's available. But as we get more disclosure around race and ethnicity, I think that's going to be helpful as well, and we'll take that into account.
Yeah, I just wanted to add another thought, and it's back to our strategy, which is advocacy, engagement, integration. But the partnerships piece of this work, it's just fundamental. So I think one group that was launched last year, which CalPERS was very honored to be invited to join through our Chief Executive, Marcy Frost. And more recently, Fiona Ma was invited as the Treasurer of California, is the Vatican's Council for Inclusive Capitalism. And I think this idea that inclusion needs to be a fundamental part of our understanding in finance, this is groundbreaking. And for this initiative, which is supported by some of the world's most influential chief investment officers and chief executives, really shows that at the highest level, this work is coming to the fore. So I think we're all incredibly proud that CalPERS is part of that work. And having Pope Francis to sprinkle some holy water on these ideas can only be a good thing. He's a wonderful ambassador for this agenda on a multi-faith basis. And we really see great potential because that initiative is also working out the framework that we need in terms of not just the data, but the practices and the implementation.
Great, thank you both.
Thank you, Anne and Samiso. Thank you, Ms. Oliveras. Next question is from Ms. Paquin.
Thank you, Madam Chair. Thank you so much for the report, Samiso. Appreciate it. It's really interesting. I think the data shows that you presented to us over the past 3 years, the impact of the executive compensation tools that you're using now and how you're analyzing that. And I'm just curious if you've seen executive comp starting to trend differently in general since there's been little bit more disclosure, a little bit more focus, and what your thoughts are on that.
Thank you for the question. The answer is not yet. And the reason why I'm saying not yet, if you recall that initially the say on pay votes themselves really are an advisory vote. And when board members don't feel they can be held accountable, they do not necessarily change their actions. And that's why we decided, starting with the 2020 proxy season, to start voting against compensation committee members on this issue, because at that point, then people actually start to take these issues seriously. And to give you just an example is, when we have our normal proxy calls with companies, the off-season proxy calls, we typically have 5% of board members on those calls. For our executive compensation calls, which we've had over 300 meetings with companies, and as when the slides points out, there were a 35% response rate as of December, which is over almost 450 companies. For those calls, we actually have around 50% of the meetings, we have a member of the board, either the board chair or the chair of the compensation committee, or other members of the compensation committee. And those discussions tend to be, sort of more engaging and straight to the point as compared to when we're having discussions with investor relations or general counsels, who then have to take it to the board. So if you're actually talking to someone who's representing your interests on the boards, those discussions tend to be different. We expect to see that having an impact and going forward. And speaking of the CII panel, which I was on, this is one of the things that we've been encouraging other investors to say, if you're not happy with the pay that is out there, which is not aligned with performance, you should start voting against directors. It's to start voting against compensation committee members. That is the only way we can get the change. That is the only way we can drive results. So from our discussions have been really open and frank, and we're hopeful that we'll start seeing some change. But it has to be a more market-wide approach. It can't just be CalPERS. We only hold about roughly 50 basis points of every company on average. So we need all other investors to start, voting against directors on this issue.
Thank you.
Thank you, Samiso. Mr. Miller.
Oh, okay. I thought Ms. Middleton was ahead of me there, but
it's okay.
You have a comment that said, oh, I see. You were making a comment about Ann at CII. I see. Oh, well, then I will, if you want, I will go to Ms. Middleton.
And then I have a specific comment after, so.
Okay. But congratulations, Ann. You did very well at CII. I guess you were the keynote speaker. So thank you very much. Go ahead, Lisa.
All right. Thank you, Madam Chair. And first, Samiso, and let me add my congratulations and my deep appreciation for the work that you both have done. Could you describe what success, if any, we have seen in efforts to increase LGBTQ diversity on corporate boards and in C-suites, and most particularly, have we seen any success in obtaining any metrics in this area? Thank you.
Yeah, I can add something from a couple of years ago, Ms. Middleton, which was a very important piece of research that was presented to the board, which came from Credit Suisse, if I recall correctly. And what it showed, their head of research at that point, she set out some interesting work whereby companies that had either C-suite or board members who were openly declaring their gender identity and sexuality and status were associated with outperformance, financial performance. And one of the explanations of that is that if you create an environment of inclusion, then people feel comfortable in being able to, not feeling the need to hide who they are. And so therefore, I think this was actually a really important piece of work. That the sensitivity in the discussions that we're having is self-identification is the critical point here in order to protect people's privacy and to make sure that individuals are in control of what is, understood about their particular status. With race and gender, likewise, we are supporting this being done on a self-identification basis, because we don't want this turning into some sort of box-ticking exercise, which is not in the spirit of inclusion. But anyway, Samiso, is there, and of course, thank you following you specifically raising this with management quite recently. The definition of diversity that we have for our engagement with regulators and also with companies has now been expanded to include sexual orientation and gender identity, which I think was a very important improvement on the language that we had. But Samiso, would you like to add to that?
Yeah, I think you covered it well. And I think the issue is the data availability and the fact that it has to be voluntarily self-identified in terms of the different aspects of diversity. But what we have done is, and mentioned, is that we share with companies our definition of diversity, which is broad, which includes all aspects of diversity. And we are hopeful that more and more people start self-identifying, and that voluntary data is available. With the Equila Diversity Network, for example, we're seeing a lot more partners joining the Equila Diversity Network, which is what houses our 3D. And it is our hope that as people join, they also self-identify. And even on race and ethnicity, we're actually seeing people not self-identifying on those aspects as well. So it's a challenge until we have that data available.
Again, thank you for your work. If I could add one comment, and I've heard many conversations around this issue of privacy and the need to self-identify. In 2021, if an individual is working in a large organization and believes that they are frightened or reluctant to self-identify, it is a crimson red flag that organization is in severe trouble in terms of its commitment to diversity and inclusion. Thank you.
Thank you, Ms. Middleton. I agree. Mr. Miller.
Yeah, thank you. Great presentation, Samiso, and I enjoyed the CII conference. And one of the things that I noticed when they did kind of a little kind of a round robin wrap up of proxy voting stuff from various members and organizations. And one of the things that I heard, I can't remember exactly who it was mentioned, and it's something I've been very interested in for a long time, was not just looking at greenhouse gas emissions. And I'm glad to see Exxon has been responsive to our entreaties there, but they were actually looking at engaging on releases of hazardous and toxic substances, particularly to EJ communities, which to me in some ways gets completely lost in the shuffle when we think about global climate change as being the big target. But at the same time, the incredible amount of toxic and other hazardous pollution that's going into our planet is and has been a problem for since way before Love Canal. And so I found that interesting. It's one of the first times I've ever heard an institution mention that they had that focus, which has been a huge focus for the environmental communities and government here in the US, particularly in California, but also in some of the European countries. and is a huge problem in much of the developed and developing world, particularly China and some other countries. So just wanted to make that comment, and it's there's more to pollution than greenhouse gas emissions.
Yeah, maybe I could thank you, Mr. Miller, for the kind words and also for this important observation. When the first science was really mapped out around this concept of planetary boundaries, this is the idea that actually are physical limits to what the planet can cope with. And greenhouse gases are just one of the 9. You know, there's nitrogen runoff, there's plastic, single plastic use waste, antibiotics, hormones. So this whole question of sustainability certainly has a much broader range, as you rightly say. The focus on the greenhouse gases is because this is something we can't postpone. There's a time limit to the warming, which can then trigger all these other impacts. So I think when we were developing our strategic plan 5 years ago, it was like, we have to focus on something which is time bound, where we need results. And I think the work Smisa was talking about with Climate Action 100 Plus shows we're making progress. But one of the questions we've been asked by other groups is, could we use a Climate Action 100 Plus model to tackle other issues on these planetary boundaries, like single-use plastic, nitrogen, and so forth? And the answer is yes. And, you know, please, you know, other investors who've got insight into this have got an opportunity to move on it. And we will be supportive, because we pick these issues up in CalPERS principles in some detail. The other thing I wanted to mention is that in terms of getting this integrated approach on environmental and financial issues, we've developed, we spent nearly 2 years doing it, but we've developed and just launched the benchmark for tracking companies' progress in response to Climate Action 100 Plus. There are 10 elements, which include financial measures like CapEx, but also the various other measures that need to be taken on the financial front, as well as operational, and as well as having a placeholder for this concept of the just transition, which is where our diversity and inclusion work, our human capital markets work, human capital management work, really connects with our environmental work. So I think that benchmark is a good example of how you can, in an organized way, approach these sorts of issues. But you're absolutely right to flag them.
Yeah, I very much appreciate that. And one of the things, as you know, 30 plus years in environmental regulation, we've kind of learned is that companies that are not doing well in terms of compliance, even public record stuff on water pollution, are also screwing up on air pollution. They're also screwing up on hazardous waste. Vice versa, if you come into it from the worker safety side, you also then look around and start finding environmental safety issues and violations of hazardous waste law, et cetera. And you look a little further and you start seeing they're not doing their disclosures. They're all kind of indicators of a corporate culture that leads to performance issues, that leads to impacts on risk and risk for investors as well. So it's, as you say, it's all integrated, it's all linked. It's just what thread do you start pulling on to get to it? I think I'm encouraged in the longer run that we'll have more avenues, because the companies that are not doing well with integrity, whether it be on the environmental regulatory side or pollution or greenhouse gas or worker safety or financial reporting, it's all out of the same less than optimal corporate culture that allows those kind of things to go on. And even as far as just not having real strong pollution prevention programs, you also find that they often also don't have real good process improvement or organizational improvement, and they're creating more waste than they need to, and they're not as efficient in their manufacturing. So all connected, and I'm glad we're seeing more of a holistic approach to the whole subject.
Thank you, David. It looks like, Samiso, I think we're done here. I don't think I have any other questions. And Samiso, thank you so much for your presentation, as usual. It was amazing. We're moving on to our next item, which is an action item, our 5-year divestment review. That's 9A. And I'm throwing it back to you, Dave.
All right. Thank you, Madam Chair. Yes, and definitely thanks to Samiso and to Ann for the update, and really also thanks to Samiso and his team for all of the progress. I mean, all the progress around Climate Action 100 plus corporate board diversity, executive compensation. That's the result of hundreds and hundreds and hundreds of phone calls and meetings with both peers and portfolio companies. So, we see the results quickly. It comes from a whole lot of work. So really great work by the team. And we know that these are critical efforts in support of our mission of managing the investment portfolio in an efficient and risk-aware manner to generate returns to sustainably pay benefits. So as you say, with that, we find ourselves at our last agenda item of the day. And this is an action item on our every 5-year review of CalPERS divestments. I saw that Christine Gogan was brought forward. If we can make sure that Ann stays forward, and then can we also please bring Nelson Daconcesau, Daniel Ingram, and Steve Foresti from Wilshire to have available for questions. And with that, Christine, I will turn it over to you to take us through the item.
Very good. Good afternoon, ladies and gentlemen of the Investment Committee. Christine Gogan, CalPERS Investment Office. I'm here today to present the 5-year review of the active divestments called for in the Total Fund Investment Policy. You'll recall in November 2020, Wilshire presented their annual review of divestments. The 5-year review that I will be presenting is the work product of a multidisciplinary team, including the efforts of the Investment Controls and Operational Risk Team, the Research and Strategy Group, the Corporate Governance Team, the Board Governance and Sustainability Group, the Legal Office, and the Board's consultants, Wilshire. Team members, as Dan mentioned, from each of these groups will be available to address questions the committee may have at the conclusion of this presentation. So if we could flip to page 2 of the presentation. There you go. Thank you very much. The Total Fund Investment Policy requires that at least once every 5 years, CalPERS presents a review of the active divestments, including an economic analysis of the risk and return impacts on the portfolio, and present this analysis to the committee for determination as to whether continuation of the divestments is consistent with fiduciary duties. If we could now move to page 3. Thank you. Page 3 presents the 5 active divestment mandates and groups them according to whether they are board-directed mandates or legislatively directed mandates. I wanted to briefly describe each of the 5 active divestment mandates before we turn to the economic analysis. So first, the 2 board divestment mandates are tobacco, which has been in effect since the first quarter of 2001 and applies to companies whose primary business includes the production and sale of cigarettes. Second, firearms, which has been in effect since the second quarter of 2013, applies to assault-style weapons that are illegal for sale to private persons in the state of California. Next, I'd like to describe each of the 3 legislative divestment mandates. First, the Sudan Act, which has been in effect since the third quarter of 2010, applies to statutorily specified active business operations in Sudan that include oil-related activities or energy or power-related operations or contracts with another company with business operations in the oil, energy, and power sectors of Sudan. The second legislative divestment mandate is the Iran Act, which has been in effect since the third quarter of 2011 and applies to statutorily specified investments in the energy sector in Iran, including companies that provide oil or liquefied natural gas tankers or products used to construct or maintain pipelines used to transport oil or liquefied natural gas. And the fifth divestment mandate is thermal coal, which has been in effect since the third quarter of 2017, which prohibits CalPERS from investing in public equity or debt securities of publicly traded companies that generate more than 50% of their revenue from the mining of thermal coal. In connection with our ongoing monitoring, CalPERS has continued to engage companies regarding their plans to bring revenues from the mining of thermal coal below 50%. In fact, in October of 2020, 3 companies were identified whose share of revenue from mining thermal coal was above 50%, and the 3 companies engaged with our corporate governance team to discuss transition plans to reduce coal revenues and told us the plans continue to remain in development. Our corporate governance team, has reported to the board that we continue to assess progress with these 3 companies and will report back later in 2021 regarding next steps. If we could now please turn to page 4 of the PowerPoint deck. Thank you. So for this economic analysis summary, there's a lot of information on the page. So we have provided information regarding the relative size of each of the 5 divestments, as well as the return impacts over both 1 year as well as inception to date, with risk impacts measured by realized tracking error and predicted tracking error. Since each of the divestments' relative inception date, all divestments other than tobacco have generated positive returns with small relative impacts on total fund risk. To better understand the economic analysis we have presented in this table, I would like to walk you through the first divestment presented in the table to explain each of the columns presented. So first, on the far left, we present the dollar exposure of each investment. For tobacco, the divestment has resulted in $1.125 billion of divested holdings, which translates to 0.524% of the global equity exposure as of November 2020. The next columns present both the annual and inception to date return impacts of each of the 5 divestments as computed by Wilshire Associates. For tobacco, the column labeled since last affirmation is a 1-year number, and the result of the tobacco divestment is a positive return impact over the 1-year period of $856 million, whereas the inception to date divestment number, which for tobacco again extends back to 2001, is a loss of approximately $3.7 billion. Turning next to the risk measures, we are showing 2 risk measures, predicted and realized tracking error relative to a cap-weighted benchmark. Of the 5 divestments shown in this table, tobacco with a predicted tracking error of 0.063 and a realized tracking error of 0.165% over a 10-year period has the largest tracking error and therefore the greatest risk impact of the 5 divestments shown in the table. Finally, the last column on the table displays the information ratio, the information ratio for tobacco of 0.72% reflects that over the 5-year period shown, the tobacco divested portfolio outperformed a portfolio that included tobacco. So if we could please turn to the next page, page 5. I wanted to call attention to the fact that we are not reviewing the emerging markets equity principles as a divestment because CalPERS public equity benchmark is screened to remove companies that have been linked to grievous human rights, environmental, or social welfare violations. Specifically, our corporate governance team evaluated the ESG risk screen and determined that it is consistent with the action taken by the investment committee in 2015 and achieves the full integration of the emerging markets equity principles into the CalPERS total fund investment policy by using this risk screen to manage the portfolio. If we could please turn to page 6. In conclusion, the staff has reviewed the economic impact of the 5 active divestments and is seeking the investment committee's direction to either remove some or all board-directed divestment restrictions or affirm continuation of the divestments as both actions are consistent with the committee's fiduciary obligations. I really thank you for your attention, and with that, we are ready for any questions you may have.
You're muted, Teresa.
Sorry about that. I have Mr. Perez has a question.
Thank you. On the board books, we get to see page 9 of 16, but you didn't speak to it. Can you address slide 9 of 16, please?
I would like to ask that Nelson Dodkin-Seco speak to that. He prepared a lot of the analysis on this, and it would be best to hear from him.
Good afternoon. Could you hear me? Can you hear me? Sorry.
Yes.
Excellent. Thank you. Good afternoon, Mr. Perez, Madam Chair, and members of the committee. I'd be happy to guide you through this slide. It might actually be useful to just remind you on slide 8 very quickly that what we performed, what the team was my team was asked to perform in the context of this item was to deliver a robust research-based 5-year forward financial assessment of each divestment policy. That is really assessing the investment relative benefit of investing $1 in each of the divestment baskets versus investing $1 in a portfolio of diversified equities or benchmark. We did that. We achieved that robustness by employing a multi-lens approach, 5 differentiated evaluation techniques, not fully independent, but largely different, that are likely to produce differentiated outcomes and would allow us to produce, again, several angles to the question of, what is the benefit of divesting or investing in those baskets. So with that, what we also did is, because the work was highly numerical, we didn't want to overwhelm you with numbers. What we did is that we summarized the findings in this table, page 9, really focusing on directionality and materiality. And by directionality, what I meant here is we have pluses and minuses and some neutrals. The pluses here really are to be interpreted as reinvesting or inversing the divestment into this basket, let's say tobacco, reinvesting in tobacco is assessed to have a positive impact relative to the benchmark based on the analysis we have performed, which is purely financially based. Purely based on those different models that we employed. And again, those are models. With that, also, if it's negative, the contrary would apply, is that reinvesting in those baskets would detract or is expected to detract based on the metrics we use or the models we use, or keeping the divestment would be expected to benefit versus a benchmark, a dollar of benchmark. What we have here, those different methods, I will just highlight very quickly, is that they really capturing very different angles, again, as I mentioned. The one that I would, to guide you through these different models, they're not all providing the same insight. The one that I would focus on first is that EVA analysis. Is that the EVA analysis really is about assessing two dimensions that I would say are defined as structural benefit or viability of a business. It's really about two questions. Is this company earning its cost of capital? And is this company, or is the management of this company having a track record or have a track record to allocate capital that is shareholder friendly, i.e. increasing or able to grow assets when the business is earning its cost of capital and above, or shrinking the business when it's not. So this is something I'd say that I would start with, which is the structural. Positive means the company is generally profitable. The business model is generally viable until something major changes. And the management company is doing a good job at managing capital. With that, then you look at the sides of that central column, and on the left side you have two types of models: the factor analysis and the total return decompositions, which are trying to really reach to a similar type of outcome with different angles. It's really about decomposing the drivers of equity returns. The factor analysis is fairly quantitative, looking at a risk premia. We understand drivers of risk relative to benchmarks, and those are industry exposures, country exposures, FX, styles, that's really important, value growth. And then we also have a quantified understanding of the past behavior of those factors. So assessing where these portfolios are versus the benchmark, understanding or realizing what those behaviors would have been over the last 30 years, then we can make an assessment of the potential benefit. And for example, tobacco here, in this case, has a plus there. It is mostly driven by its current large exposure to value, which over time has tended to revert back to the mean. And here it would be expected to perform or to add value compared to or performance versus the benchmark. Same thing for dividend yield. It is a characteristic of tobacco. Tobacco companies do deliver a high total shareholder yield, really a dividend yield to shareholders. On the opposite,
on the right,
yeah, okay.
Is Foresti on?
Yes, he is.
I am on.
There he is.
Thank you, Dan. Steve, in your opinion letter, there was two criteria that you thought was pretty appropriate, and I can't seem to find it on my board books. Can you refresh our memory?
Sure, I'd be happy to. And I'm also joined by my colleague Daniel Ingram, who penned that letter. But the way we laid it out, and to your question, Mr. Perez, the two paths that we see that are potential rationales or drivers of divestment. One would be a mission-based, or think about a healthcare organization looking at tobacco, or a religious organization looking at could be contraception, could be other things that are just misaligned with their mission. So that was one very clear path to divestment. The other path to potential divestment that we noted in the letter was an investment-based rationale, and that would fall, and this is where we continued in the letter to try to lay out a process, which is to consider the potential return impacts of, in this case, moving from a divestment program back into these segments of the market, consider the cost of those trading activities to, in this case, again, get reinvested, and then the risk, which is the unknown around the return, and we'd argue a little bit less unknown around the cost. Cost is something we've got a pretty good vision on. So to answer your question, we laid it out across a mission-based versus an investment-based potential rationale for divestment.
Thanks, Steve. And I don't know if Marcy, Teresa, or even Dan, if when this, back in 2001, when we started tobacco, and then whenever we started firearms, I mean, obviously this was mission-based, right?
No, it was not. That was at the time all those lawsuits were going on, Jason. So it was actually investment-based. As I recall, Dan, you were there, I think, right?
Yeah, so I was not here in 2001. I joined in 2004, so I was not here in 2001 with the tobacco. But my understanding is that it was around concern around the potential lawsuits around tobacco and the like. In the case of the firearms, yes, it was right in the aftermath of I believe it was Sandy Hook, and the concern was around potential litigation there as well.
That sounds an awful lot like mission-based potential. Okay, I'll leave that one be. And I know you. I saw a note from Mr. Fox saying that there's speakers in the queue, so I try not to take too much more time.
Thank you.
Hold on, I'm not done.
Oh, you're not done.
Too much more time, yeah. In the last time in November we spoke, you heard from. I'm speaking to the board at large now. Last time we talked about this, you heard from the Association of Highway Patrolmen. You heard from the League of California Cities. You heard from California Professional Firefighters. You heard from the California Special Districts Association, all encouraging you to do what we can about making the returns as opposed to, and I'm not putting words in their mouth, you can read it through the letters, but encouraging them to let us make investment decisions. And, in my point of view, replace tobacco and firearms and put blue widgets and white widgets. I don't care what they are. I think that the important part of this is that we let the investment office determine what they want to invest in or not. And then I'll ask Dan one more time. I've asked him every time we talked about this, but I'll ask him again today. Dan, all things being equal, do you want us to put restrictions on the investment office, or do you guys want to be able to do what you're paid to do?
Yeah, no, it's a great question, Mr. President. I appreciate the question. Certainly, all things being equal, fewer constraints are better than more constraints. And as it says in our policy, we prefer engagement to divestments. Our portfolio is 97% indexed in the equity side, so we definitely believe in markets being fairly efficient. So, absent a strong rationale for divestment, we prefer broader degrees of freedom. That said, with this, I do think when balancing risks, I do think in a reasonable investor, and I know we've got Ashley Dunning on the line as fiduciary counsel. I do think a reasonable investor can come to either place, especially when considering some of the certain costs that are associated with reinvesting. But specifically to your question, Mr. Perez, unequivocally, fewer constraints are better than more.
Thank you, Dan. And as we wrestle with the items in the first half of the day about the ALM cycle and talking about the discount rate, why would we as the board want to handcuff our investment office from being the studs that they are to go out there and make the returns that they need to make? So I will motion that we lift the restrictions on the divestments.
We are not taking the motion yet. Hold off on that because I've got 3 more questions from the board, 4 more, and then we have.
I'm pretty sure you can acknowledge that motion.
I said hold off on that. Hold on to it, and then make the motion when we're ready to make the motion. Okay. I had a question on the thermal coal, and maybe I should have asked it earlier. We had a mandate from the legislature to divest from thermal coal. We divested from many of the companies. 3 of them we had engaged with, and they were agreeing to our the legislation, basically. Do you have an update on where those three companies are in terms of the thermal coal and reaching the below 50% and redoing their business model?
Certainly, Madam Chair, this is something that we've spent a good bit of time on. So maybe I'll ask Ann Simpson to please take the lead on that question.
No, thank you very much for the question, Chair. You'll all recall that we did a thorough analysis of the portfolio and identified, I think, almost 24 companies that met the test, the threshold of 50% of revenues from coal. Then, in line with our board's policy, we reached out to engage those companies, because that legislation, of course, calls for the overarching fiduciary duty of the board to be respected. 3 of the companies on the list essentially said, we know we have to make this transition, that our future prosperity depends upon getting aligned with the transition to low carbon. And we felt that it was important that these companies were given a period of time to then respond, because transitioning a big company is complex and it takes time. So what we did last October was contact those 3 companies for a progress report so that we could see what measures have been taken. And you can see some of this information on their websites, the sort of climate risk reporting that they're doing and so forth. Those responses are being reviewed at the moment, and there'll be a recommendation from the investment team once that's complete. But that review of those responses is in hand. Does that answer your question, Madam Chair?
Yes, yes,
Thank you.
I was curious about that.
Yes.
I think our next person to have a question is Ms. Middleton. Oh, one more thing. I'm sorry, Lisa. I just wanted to know, as we're talking about the cost of this, right? Yes, it makes sense from what Jason's saying to just dive right back in, except that we've already lost the money that we were talking about from before. It looks like there's a high cost to getting back into some of this. And I think you said something earlier, Dan, about how oh no, it wasn't you, maybe it was Christine, about how we have decided to get out of, based on our ESG strategy, that we are not getting into companies that, are labor unfriendly, or however she put it. So that was the second part of my question, which was, we're kind of already in a, what you would call a I don't know what you call it, specialized fund, because we have these criteria already based on our ESG strategy. Then my second question is about the cost of getting back into these companies. Is it worth it for us to get back into these companies based on the transaction costs and the risk costs?
Teresa, before you continue, I just wanted to clarify. I didn't say that we should get back in. I'm just saying that we should lift the restrictions and let the investment office make that decision.
Great.
Sorry.
So Ms. Taylor, let me take a first shot at your question. So first of all, I hope we didn't give the characterization that we have big portfolio tilts around ESG in the portfolio, because certainly ESG is one of many things that we take into consideration. I mean, Ann spoke about integration being one of our key tenets in our ESG strategy, and it is. And basically, we're talking about integrating ESG considerations in every investment decision we make. That's whether it's in private markets or public markets, equity markets or income markets. ESG is one of the considerations we unequivocally take into account when we make our decision.
Right. I think
as far as
something about human rights violations, that kind of thing, that was mentioned. It was earlier in this 9A, and I thought it was Christine that talked about it, but it was human rights violations. If they're companies that are overtly human rights violators, et cetera.
It was the emerging managers issues.
Oh,
the emerging markets principles, yes, and those principles definitely still hold, and they're definitely part of our index construction methodology for sure. With respect to the costs, it is a good question. There is a cost to reinvest. Unfortunately, we don't have a crystal ball, and we don't know how all of these stocks are going to perform on a go-forward basis. Certainly, the models that Nelson referenced are models that we think may have some efficacy, but candidly, given what I said about markets being fairly efficient, if we had a model that we knew would outperform, we would just always outperform, and it doesn't work that way. That's not investment management, unfortunately. That's one of the challenges. So I do think the costs are certain. I do think that absent other considerations, to Mr. Perez's point, we would say fewer constraints are better than more. But this is where we kind of come to a balanced place. I think a reasonable decision can be made in either way, and that's one of the reasons why you don't see a strong recommendation from your investment team.
Thank you. Ms. Middleton, go ahead.
Thank you, Madam Chair. And one of my questions was going to be with relation to the 3 coal companies. And so let me just very quickly on that point, and I do have 2 others, be specific with the question, and I guess this goes to Ann. At this point, the 3 coal companies that you are looking at and engaging with are all above the 50% threshold. They, as I understand it, are developing plans that you are working with them to get under that 50% threshold. Is it accurate to say that staff at this time has not concluded that they will be unable to succeed at getting under 50%?
Thank you for the question, Ms. Middleton. As I mentioned, we did our scheduled check-in with the companies in October, and our previous report to the board, we said with these 3 companies would be coming back this year with a view. I don't want to jump ahead of the review that's ongoing, but the test will be a simple one, which is if these companies have a credible plan and they're making progress towards that 50%, then we'd consider that to be in the spirit and the letter of the law as it was drafted. If, having had this time to develop plans, we can't come to the view that there is a credible transition plan where progress is being made, then consideration of that statute will be brought to bear. But I just don't want to get ahead of, process is our friend. Being able to stand back and do all the analysis, and when we come forward with our report for the board, you can then hang your hat on that and say, they looked at this carefully, they gave the companies the chance to respond, they made a reasonable recommendation. So I'm sorry that we're not quite complete, but 2 of the companies out of the 3 did respond in some detail in October. So we have got an amount of material to go through. Thank you.
I do appreciate the answer, and I appreciate going through that. Any process has a timeline.
Yes.
I'm following that timeline. So yes. Thank you on that one.
Thank you.
Second question that I have is going back to page 3 of our agenda, where we've got the 5 industries that we have had divestment on. And with reference to number 3, Sudan, and number 4, Iran, am I accurate that in addition to California legislative restrictions, there are also federal restrictions that apply to investments in Sudan and Iran?
That's my understanding as well, Ms. Middleton.
Yeah, so Ms. Middleton, I think these exist at two levels. So there's what we call the OFAC, which is a list published by the federal government that says U.S. investors can't invest in certain companies. These are, that knocks them out of our entire universe as a U.S.-based investor. However, then after that screen, there are also still some companies that do business with Iran and Sudan, and that's what this bill was intended to go at.
So I think it would be appropriate where there is federal restriction to make note of that on our list. There's a range of opinions on divestment. There's also a range of opinion as to how much divestment we have, and depending on who I'm talking to, I sometimes come away with the conclusion that they believe that either the legislature or the board has restricted the investment office from investing in almost anything. So I'd like to get some clarity. And my last question is going to follow up on that theme. Do we maintain any type of list of all of the various industries that we have been strongly requested to divest from and have not made that divestment decision?
I think Anne may be best to, between her history here and also the fact that her office tends to field these first. Maybe Anne, can you take a stab at that one?
Yes, thank you for the question. I think that when there is a challenge that's brought to us by stakeholders or by legislators, usually there's something very, very serious at the heart of the divestment proposal. I mean, a really serious issue. And in my time here, I've seen divestment on a range of different countries, measures which conflict with each other regarding country exclusions. I remember Israel, Iran, Iraq, Turkey all being in the mix. It was the Levant, the Middle East was the focus of attention. I think that the approach that CalPERS over the years has taken is understanding that if you see potential for improvement and you see a role as an owner of the asset for being part of that, your better course of action is engagement. And of course, that's why we've focused on climate change in taking the very biggest emitters, the systemically important emitters, the toughest ones. We're not reaching for the low-hanging fruit here. And we have got a multi-year engagement, and we've teamed up with the 50 trillion other, others, $50 trillion in assets, which have come together on that. I think when an industry is in secular decline, for example, the trends on coal, or there are trends on litigation and legislation and lifestyle, for example, health costs around tobacco, predicting these long-term trends is difficult. And finding a way for companies to restore themselves to prosperity and, find new businesses, it's not an easy thing at all. So I think to sum up, I think we always have a very sympathetic hearing for those who come to us calling for divestment, because we understand something serious is driving this. But I would say there are rare situations where simply avoiding an industry or avoiding a situation is going to change it. But I think the bigger question for our board is, we are a universal owner. We have such long-term liabilities that considering risk isn't something that can be done quarter to quarter or even year to year. And I do remember the last time the board was looking at the tobacco question, some of the medical projections about the use of tobacco over generations, over decades ahead, were part of what fed into the board's discussion at the time. So I do appreciate the question about the board's role and management role, but this seems to me to be absolutely the board's role, which is setting risk tolerance, focusing on strategy, and absolutely focusing on the very long term. And then within that, our job as management is to go off and get the job done and meet those investment returns as Dan was saying.
So
Thank you.
I appreciate that. And I think I concur with everything you've said. I'm just simply asking that we be able to document clearly where we have chosen engagement over divestment so that from an information standpoint, we're in a much better position to have that conversation with our stakeholders.
Thank you. Dan, I think we'd take that as a follow-up point, perhaps. But I apologize if I wasn't clear enough. Thank you.
I was writing that down. Ms. Taylor, unless you disagree, we'll take that. We'll take that as direction.
I agree. I think it's a great idea because it is important that that our stakeholders understand. And honestly, when you look at what we've actually divested from, that's not legislatively mandated, it's two things. So and I don't think a tobacco company has it's hard to engage with a tobacco company. I don't think they can change their business model. I need to move on. And you are done, Ms. Middleton, correct? Okay. Mr. Rubalcaba.
Thank you, Ms. Taylor. I had two questions. Ms. Simpson, you mentioned there's some analysis underway for the coal company, the 3 coal companies, but you didn't. I know it's taking time and processes are friend. I like that. But what is the timetable roughly before the report comes to the board or the analysis comes to the board?
I am personally not doing the calculations, but I know who is. So, Dan, can I ping this back to you?
Yeah, maybe I'll jump in there. Mr. Rubalcaba, it's happening on Samiso's team, whom you just heard from, of course, in the last item. I think it's probably reasonable to say that it happens. I'll under promise and over deliver. Why don't we say this calendar year, but we'll shoot for it and significantly sooner than that, if that meets your timetable.
Thank you. I just needed a sense of time frame. Thank you. The other question, I just follow up on the chair's comments about reinvestment transition costs. I noticed that the Wilshire letter does state that that these are meaningful numbers, meaning the cost of reinvesting. And I was hoping somebody could explain to us. There's a chart on page 15, reinvestment transaction costs. What these numbers mean and how they were developed. Please, thank you.
Dan, do you know who that would be?
Yeah, I'm sorry, can you hear me?
Yes.
Yes. Uh-oh, you went away for a minute and your phone is off. You're off, Dan. It looks like almost.
Can you hear me now?
Yes.
Okay, good. Yeah, my Zoom was freezing on me and then jumping all over the place, not responding. Okay, so those basically come from what we call a transaction cost model. So we have a series of models that we can use across the asset classes that allow us to estimate what things will cost to trade. So what those models do is they look at the bid offer spread of stocks. They look at kind of what historical amount of liquidity a certain stock has. We compare that to how much stock we would be looking to trade, and then what it does is it basically uses some quantitative metrics to interpret to come to some expected costs. It is based on a model, so we know that it'll differ from the model, but they've proven to be fairly accurate historically. By accurate, I mean indicatively accurate in terms of direction and orders of magnitude.
But can you explain what they represent? Does that mean there's a trading cost that goes to, is that an internal cost? Is that something that you pay to the market? I mean, I'm just trying to understand what they represent. What does, there's a range, for example, for tobacco. What does low?
Right.
I mean,
So
what?
Yeah.
Why is there such a range, and what does it represent exactly? A bit more.
Yeah.
Just
Okay.
simpler.
So there are two main things that represents. Is that first of all, we were buying back into tobacco. We would be expecting to generally be demanding liquidity and be buying at the offered side, right? So just the way that if you were, buying a house, you would expect to kind of, pay the seller's asking price for the house. We would expect to pay some cost by going to who's willing to sell it. Secondly, there's commissions in there.
Okay.
And then thirdly, they're probably, given that in some countries, specifically the UK, there's a stamp tax, there's some tax there also.
Okay, thank you.
All right, thank you, Mr. Rubalcava. Ms. Brown, you're up next.
Thank you. Thank you, Madam Chair. Just two quick comments. First, I'd like to say that I agree with Ms. Middleton about documenting our decisions. Why? Historical knowledge is critical for the board, especially as, I think a long time ago, the board didn't turn over very often, but now, I mean, the majority of us are new. And so I think that's very important, but and for the stakeholders. So I hope we can do that. And then I just wanted to mention that, we talked earlier about concentration concerns with public equities as well as private investments. I raised that issue. And I think that limiting what the staff can invest in could be problematic, especially when it comes to concentration concerns. Our investment team are professionals, and we trust them with a delegated authority to invest up to just $2 billion. They don't have to come to us. They can just do it. And we trust them to do their job prudently. And I, for one, want to remove constraints or barriers on staff. With their delegated authority, the staff should decide what to buy or sell, when to buy or sell, how much to buy or sell. And I think that's the way we should move. So I'm not saying spend the money and reinvest, but as we talked about over concentration on some public equities, maybe there's some opportunities here if we open up and allow the staff to make those decisions and the board take the handcuffs off. Thank you.
So I just want to clarify, I think there's a perception with these comments. These are directed divestments. The staff gets to invest wherever they want. So these are directed divestments. That's not, it's outside of the market, yes, and it makes it a special portfolio for us when we do this. But again, the staff invests wherever they want and makes the decision themselves. These are directed divestments. 3 of them are from the federal or the state government, and 2 were from past boards.
I'm not talking, I'm going to be clear, I'm not talking about the ones the federal government tells us we can't do. That's not in our purview. But there are some in our purview, and those are the ones I'm talking about.
Right, right. But it's sounding like saying that we're handcuffing the staff.
We are. We are. We are. We told them you can't do. We've told them you can't do tobacco, and right. So we have handcuffed the staff. Thank you.
Thank you, Mr. Miller.
Again, I thought Ramon was in there. Okay. Oh, okay. Yeah, a couple thoughts here. One is staff aren't picking individual companies to invest or divest in. So when these decisions happened, it restricted, but it's not like if these restrictions weren't there, that staff would be identifying specific tobacco and firearms companies for us to invest in as investments in those individual companies. If I understand this, it would cause us to potentially have to go back and look at funds and indexing and all that kind of stuff. And there would be significant costs of getting back in. And so the whole cost aspect of it associated with that concerns me. And if I'm wrong about that, Deanne or somebody interject. The other thing is, when I look at, for example, let's take the tobacco ones. We lost a lot of money because it cost us a lot to divest from them at the time we did it. Then you go a year later, and pretty quickly you start to see, and we don't have all those numbers this time, we did in the past, that as long as you're not hung up on that cumulative number, I mean, there was money lost, yep, but from very shortly thereafter, it actually turned out to be a good decision from a financial perspective. We were better off without tobacco. And all those real risks that are associated with that specific industry and that specific investment that may not really appear in these tracking error calculations, which are aggregate stuff from history and from what's going on, those are still very real. There's still huge risks associated with that industry globally in terms of health, litigation, potential liabilities, not to mention ag industry in general, that all still exist. And it's still making sense financially for us to not be in tobacco. And so, and I think the same goes even more so with the firearm decision, just from a purely money lost, money to be gained sense, it just doesn't make sense to mess with these decisions at this point, just because of the costs potentially to do it, and again, it throws us into a potential big challenge with explaining this to anyone, because right now, tobacco and firearm divestment on a ever since those initial losses of the costs of divesting have actually been a benefit to us.
Thank you, Mr. Miller. I don't see anyone else, so we're on to our public callers now. I have 8 callers on 9A, if I'm correct. Mr. Fox?
Yes, Madam Chair. Can you hear me?
I can.
Thank you, Madam Chair. Our first caller is Kathy Carriage. She is speaking on item 9A.
Hi, hopefully you can hear me.
Yes,
do I have to do anything?
I can hear you.
Okay. There's a huge disconnect between the video and the audio, like a couple of minutes, it seems. I think that I'm speaking about particularly about the coal companies and the thermal coal production. CalPERS is in the dirty 30 of the top investment in this industry. So I think you really need to be looking at getting rid of those companies. Listening to your report, it looks like 2 of the companies have responded and are, I'm assuming, working to divest themselves of that. I'd be very curious about what the other company, what their response has been. And if that company has not been cooperative, I think you probably should be immediately selling it. And to give a year-long time, I'm not an expert, but that seems to me like an awfully long period of time, especially when this has been mandated by the state. This is state legislation. And we're talking here about companies that, basically coal is killing our future. huge greenhouse gas emitter. It's part of what's causing fires in California, floods, sea level rise, ocean acidification. Do we really want to be invested in that industry whatsoever? But the other part of it is that these are bad investments. Fossil fuel industry has not done well as far as rate of returns. Last year, in general, they lost 41%. This is at a time period when the S&P 500 gained 10%, and your rate of return was, I think you said 12%. So not only are these companies, this is a dying industry. And if it's not dying, it's killing us. So why would you want to maintain an investment in an industry that really should be going out of business completely? Thank you.
Thank you. Next caller, please, Mr. Fox.
Yes, Madam Chair, we have Dr. Margaret Chin.
Good afternoon. Can you hear me? Hello.
Yes, we can hear you.
Can you hear me?
Yes, we can.
Oh, wonderful. Thank you so much. Thank you for allowing me to speak to you today. My name is Dr. Margaret Chen. I come in behalf of Climate Health Now and the Physicians for Social Responsibility, two organizations of health professionals who are alarmed about the overwhelming negative effects of climate change on health and mortality. I'm an OBGYN physician who has devoted my entire life to ensuring the health of women, especially pregnant women and their unborn babies. With the extreme climate changes, their health is in jeopardy. The health and safety of our future generation is at stake. Air pollution is causing increased pregnancy complications, chronic lung diseases, greater complications to COVID disease and early deaths, and so much more. The increased temperatures have caused droughts and wildfires here in California. These climate events have caused an alarming increase in preterm births, smaller than expected size of babies, and stillbirths. We Californians will never forget that day in September 2020 when we never saw the sun through the orange-gray haze of the wildfire air pollution. We know the primary cause of climate change is greenhouse gases from fossil fuel extraction, production, and use. We need to protect my vulnerable patients, the mothers and their babies, and stop a cause of preterm births, small babies, and stillbirth. We need to stop supporting the fossil fuel industries that cause continued damage to the health of my patients and the world we live in. The trend towards renewable energy sources is inevitable. The financial health of the oil and gas and coal industries are failing. The diagnosis is clear. Fossil fuels are causing a health emergency. You have a fiduciary responsibility, a moral and social responsibility, and a health mandate from the medical community to divest from fossil fuel and coal industries. Thank you so much.
Thank you. Mr. Fox, next caller.
Yes, Madam Chair, we have Sandy Emerson with Fossil Free California.
I'm Sandy Emerson. I'm the board president of Fossil Free California, and we're asking CalPERS to finish its mandated thermal coal divestment. The three companies that you've identified as still having more than 50% of their revenue from the mining of thermal coal, in fact, are much higher than that. Exxaro from South Africa has over 90% of its revenue from thermal coal. Adaro from Indonesia has over 90% of its revenue from thermal coal. And Banpu from Thailand has 88% of its revenue from thermal coal. And this is as of November of last year, November 2020. These three companies together produce more than 138 megatons of coal every year, equivalent to almost 279 megatons of CO2. In fact, South African company Exxaro Resources owns more than 31 billion tons of recoverable coal, which is more than enough to create a tipping point for Earth's climate. The scope of new and emerging coal projects that these companies support is dangerous to climate health. Last year during the pandemic, Exxaro increased its coal exports by 39%, and it's continued to engage in expansion projects, identifying new markets in India and China, despite an uprising organized by mine workers to protest human rights and safety practices. Exxaro has been actively participating in expansion projects in Indonesia since 2016, with its continued work on the Central Java Power Project. This endeavor has been delayed, but they're still hoping to expand. And Banpu is planning expansion into Chinese, Australian, and Indonesian markets. I'm looking forward to your analysis. I think these companies have a long way to go. If you finish this mandated divestment for a portfolio worth more than $400 billion, the total value of these investments is somewhere between $8.5 and $10 million. So it's insignificant. The financed emissions potential of these thermal coal companies far outweighs the market value of their shares. Adding these three companies to the exclusion list would allow CalPERS to complete its compliance with the requirements of SB 185 and eliminate this risk to its portfolio and to the planet. Thank you.
Mr. Fox, our next caller.
Yes, Madam Chair, our next caller is Dr. Robert Gould with the San Francisco Physicians for Social Responsibility.
Can you hear me okay?
Yes, we can. Yes, we can.
Okay, thank you. Hi, I'm Dr. Robert Gould, a Californian UCSF professor and president of San Francisco Bay Physicians for Social Responsibility. Representing hundreds of California health professionals, PSR calls on CalPERS to swiftly and completely divest from coal as well as other fossil fuels. Numerous scientific reports, such as the recent Fourth National Climate Assessment, have warned us about the rapidly unfolding impacts of global warming that gravely threaten our health, including extreme weather events and wildfires. While exacerbating our COVID pandemic crisis, such climate health impacts particularly devastate our communities made most vulnerable by systemic racism, environmental injustice, hunger, and poverty. Understanding that coal is responsible for 44% of global energy-related carbon dioxide emissions driving our climate crisis, we find it unconscionable that CalPERS is almost $8 billion invested in companies within the thermal coal value chain, and we join many others in demanding that CalPERS immediately divest from thermal coal producers like Exxaro, and Banpu. In line with policies promulgated by the American Medical Association, American Public Health Association, and numerous health specialty societies urging swift climate action, health professionals increasingly recognize that divestment from coal and other fossil fuels is cost-effective, health-protective, preventative medicine. In fact, since 2018, it has been the AMA's official policy, quote, to protect human health from the effects of climate change by ending its investments in fossil fuel companies, unquote. While committing to speedy divestment from coal and other fossil fuels, CalPERS should invest its vast financial holdings in renewable and sustainable non-nuclear energy portfolios that could provide more financial security for CalPERS retirees than squandering assets in coal stocks that have plunged in value over the recent period. Through such divestment and reallocation, CalPERS can contribute significantly towards assuring the security, health, and survival of our children and grandchildren by helping avert the catastrophic health consequences of global warming that threaten all human civilization. Thank you for your time.
Thank you, Dr. Gould. Mr. Fox, next caller.
Yes, Madam Chair, next caller is Sheila Thorne, member of CSA Retired and Fossil Free California.
Hello, my name is Sheila Thorne. I'm a CalPERS beneficiary and a retired member of CFA. The CalPERS member news I received this month justifies not divesting by saying, quote, as an owner of a company, we can work with that company to change behavior, and by divesting, we lose our influence. But what influence do you really have? For example, Duke Energy. It's one of the largest CalPERS holdings on the global coal exit list and among the top 25 emitters in the Climate Action 100 and the third highest emitter of Scope 1 and 2 emissions owned by the CalPERS portfolio. And it has pledged to reduce carbon emissions 50% from a 2005 baseline in the power side of its business by 2030 and be net zero by 2050. That all sounds really good. However, an extensive January 2021 study by the Sierra Club of major U.S. utility companies found that actually, of Duke Energy's 54 million megawatt hours of coal generation in 2019, only 11% is firmly committed to retire by the end of 2030. Further, Duke intends to build as much as 7,800 megawatts of new gas by 2030. This new gas capacity could generate nearly as much power as the entirety of Duke's existing coal fleet. In other words, Duke is planning for an energy future centered on gas, not clean energy. CalPERS' own June 2020 investment strategy on climate change reports, quote, the longer the delay on reducing CO2 emissions towards zero, the larger the likelihood of exceeding 1.5 degrees Celsius. Duke Energy has explicitly stated that the planned gas plants coming online in the late 2020s and 2030s will be stranded assets as of 2050. So another way of meeting its pledge, besides not actually meeting it, is to pass on the cost to ratepayers and shareholders. Then, instead of building out its solar and wind capacities and battery storage, Duke is relying on suddenly getting to net zero by a hypothetical geothermal technology that has yet to be developed and tested. They call them unicorns. Who knows if it will actually happen? This is an example of empty climate pledges by Climate Action 100 companies that are underhandedly seeking to delay real action for as long as possible in order to continue to reap whatever profits they can in the meantime. ExxonMobil and Shell have both made similar empty pledges, and it's time to either call them out or divest them. There are both mission-based and investment-based reasons for doing so. Thank you.
Thank you. Mr. Fox, our next caller.
Yes, Madam Chair, we have Sarah Thies from Fossil Free California.
Hi, I'm Sarah Thies, as you know, CalPERS retiree and Fossil Free California board member. I have to say I am disappointed that the board may be giving the 3 coal companies another year, given their continued dedication to coal after promising to change business models in 2017. Today, I want to give you some information about the ESG practices of these 3 companies, which, as Mr. Miller pointed out, often indicate larger problems in a company. The Center for Environmental Rights, a South African NGO, monitors whether the largest emitters of greenhouse gases there disclose and manage their climate-related risks effectively. Its most recent report in 2019 faulted Exxaro for failing to support the Task Force on Climate-Related Financial Disclosure, failure to identify climate change as a material business risk to its shareholders, or have a policy to manage it, and other matters. Exxaro committed to setting a science-based target in 2015, but had not yet implemented it. In another report, the same NGO documented the environmental destruction of coal mining, for instance, the health impacts on nearby communities when blasting from one of Exxaro's open pit mines spreads coal dust on the towns, the health-threatening pollutants in irrigation water that prevent farmers from exporting their crops to Europe, and the degradation of the land, which can never be rehabilitated back to their full potential. Coal mining also uses a tremendous amount of water, a scarce resource in South Africa. Exxaro has been found to operate without proper water use permits and was criminally charged for this. Finally, at a protest last year, Exxaro's private security firm shot and killed one of the people protesting Exxaro's atrocious practices. As to bamboo, Greenpeace issued a report on mining in Indonesia, with bamboo a primary target accused of causing environmental destruction. And Adaro operates in the Philippines, has one of the largest mine concessions in an area where there was severe flooding earlier this year, which meant 24 deaths and displacement of over 100,000 people. The flood is linked to the severe deforestation and sedimentation caused by the mining operations. A British NGO, Global Witness, published a report raising questions about Adaro's questionable use of offshore tax havens, and the Indonesian tax authorities opened a major case of tax manipulation against Adaro. I hope this information is helpful as you consider whether to withdraw investments from the 3 companies pursuant to SB 185. And thank you for listening.
Thank you. I think there's 2 more callers, Mr. Fox?
Yes, Madam Chair, we have 2 more callers on this item. Next, we have Dr. Robert Gerling, CSU retired faculty.
I represent 2,000 members of the Emeritus and Retired Faculty Staff and Staff Association. We're all members of CalPERS. And let me begin by saying I've listened closely to your deliberations so far. We certainly respect and applaud the cautious actions that have been taken with regard to and respect to corporate engagement and governance. And it's very encouraging to hear, particularly the 12.4% return that Dan and his team have achieved over this last year. And thank you for your hard work on our behalf. However, my members have asked why CalPERS is not doing more with respect to climate change and pollution. They tell me they'd like to see their money invested in industries that will forestall catastrophic climate change. And they ask, why is CalPERS continuing its investments in coal and coal-fired utilities and other fossil fuels when a livable future requires decreasing such investments? As we look at things, we see that CalPERS coal policy lags far behind many other institutional investors. Moreover, global economic and policy trends indicate that investments in the coal sector are really unlikely to prove profitable in the future. I mean, it's very clear that the trend has been down, and that there's so many other investors are getting out of that industry or moving away from that, in line with the recommendations of the International Panel on Climate Change. So we believe that CalPERS should follow the spirit of the 185 legislation by removing this financial risk from its portfolio. In addition to that, some have brought to my attention the work of Bloomberg's analysis, Nathaniel Bullard, who wrote, in terms of growth, there's no apparent penalty for removing fossil fuel companies from indexed investing. The S&P 500 fossil fuel total return index has outperformed the S&P 500 total return index since its inception in 2012. So there's very strong financial arguments that lie behind this. So we're really asking, in view of this growing urgency of climate change, we're asking the CalPERS board to accelerate its action and expand its efforts to divest in fossil fuels by stop investing in fossil fuel companies immediately, reinvest fossil fuel.
Sir, I'm sorry, sir. You're done. Your time is up.
Okay, thank you.
Thank you.
Okay, I got it.
Mr.
Thank
Fox?
you.
Oops.
Yes, Madam Chair, we have Jerry Fontaine from CSR.
Kelly, can you hear me?
Yes.
Okay, this is Jerry Fontaine. I'm calling in as a stakeholder of the CalPERS, representing myself. I'd like to suggest that the board reevaluate the divestment from firearms. As presented today, firearms have been divested from that subject because of sales of weapons, tax-style weapons in the state of California. Now, California already has an extensive list of firearms that cannot be sold in the state of California, to include rifles, pistols, revolvers. So what CalPERS is trying to accomplish may not be allowed in the state of California in the first place. So I would suggest that they look at what California does not allow and reevaluate the divestments from firearms. Thank you.
Thank you. Mr. Fox, are there any other commenters on 9A?
Madam Chair, that concludes your public comment on item 9A. You will have at least 2 callers for public comment number 11.
Okay, thank you very much. So at this point, now we can take a motion to either remove some or all board-directed divestment restrictions or affirm the continuation of divestments. What's the pleasure of the board?
I'd move we affirm.
Ms. Taylor, you had a motion that was in progress by Ms.
Sorry, you're right. Jason, make the motion.
Where is he?
All right, so we've heard from staff. We heard from management, our own internal management. We heard from our consultants. We've heard from labor, being California Professional Firefighters, California Association of Highway Patrolmen. And we heard from employers through the California League of Cities and through the California Special District Association. And they all suggest the same, let the investment team make the decisions. So I move that we lift the divestments from tobacco and firearms and put that authority back in the hands of the investment office to make that determination when and if to reinvest.
Thank you. Is there a second?
I'll second.
Okay, it's been motioned by Mr. Perez, second by Ms. Brown. Ms. Hopper, can you call?
Ms. Taylor, I'm sorry to interject, but I believe the policy calls for independent votes on each divestment, and maybe I'll ask Mr. Jacobs to confirm that if he can. But my understanding of the policy is that each one needs to be voted on independently.
Each one needs to be voted on.
Give me 3.
Pam, hold on.
Can folks hear me?
Yeah.
Okay. So there can be an up or down vote on all 5. But if we're going to separate them out, it probably is better practice at least to have at least these 2 taken up individually.
Okay. I'm not sure that we can divest from or reinvest in the other 3. Is that correct? Because those are mandated.
They could be reinvested in if the board makes the well, Sudan and Iran, no, but the other one.
Okay. So right now, let's do 1. You want to redo the motion, Jason? Start with 1 and then go to the other?
Yes, ma'am. So all the stuff I said, but for tobacco. Just lift the tobacco, put it back in the investment office.
Okay, so there's a motion to lift the divestment from tobacco. We don't need to put it in the divestment office. That if we're lifting the divestment, they would reinvest. I need a second.
Hold on. They wouldn't reinvest automatically. I want to put that authority back in their office. It has nothing. So the bigger picture is not just for tobacco, not for these 2 widgets right here. The bigger issue is for every other divestment that's going to come to this board. This is a retirement fund, not a political fund. And that's what I want the goal here to be.
So the board made the decision to divest. If we're saying to reinvest, then we are directing staff to reinvest. That's what you're saying.
That's not my motion. My motion is to lift the restriction.
All right. Remove the restriction and that's not
I'll say it again.
I'm trying to do it how it reads, Jason.
You can change it.
So remove the restriction and let staff reinvest if they want. Is that what you're saying?
I'll just start again. I submit my motion to remove the restrictions that we placed on the tobacco divestments and put the responsibility and authority back into the investment office to make that decision if and when they see that it's appropriate.
And Mr. Jacobs, is that an appropriate motion?
Yes, it is.
All right, thank you. Can I have a second?
Second.
All right, so it's been motioned by Mr. Perez, seconded by Ms. Brown. Ms. Hopper?
Margaret Brown,
Aye.
Rob Fechner,
No.
Henry Jones,
No.
Matthew Seehofer, Fiona Ma,
No.
Lisa Middleton,
No.
David Miller,
No.
Stacy Oliveris,
I abstain.
Irene Ortega,
No.
Jason Perez,
Yes.
Ramon Rubicava,
No.
Shonda Wesley,
No.
Betty Yee,
Lynn Paquin for Betty Yee is no vote.
Okay, Madam Chair, I have 2 yeses by Margaret Brown, 1 by Jason Perez. I have 9 noes and 1 abstention by Stacy Oliveris. Motion made by Jason Perez, seconded by Margaret Brown.
Thank you. Motion fails. Can I get the next motion, please?
Yes, ma'am. My motion for the same thing, but for firearms.
All right. So remove the divestment restrictions on firearms. And what was it? So I have to repeat it.
It's okay. And put the authority to reinvest if and when they see it appropriate in the investment office.
Okay.
And that's the second.
All right. It's been motioned by Mr. Perez, second by Ms. Brown. Ms. Hopper, please take the roll for the vote.
Margaret Brown,
Aye.
Rob Fechner,
No.
Henry Jones,
No.
Matthew Seehofer, Fiona Ma,
No.
Lisa Middleton,
No.
David Miller,
No.
Stacy Oliveris,
She had a drop off.
Irene Ortega,
No.
Jason Perez,
Yes.
Ramon Rubicava,
No.
Shonda Wesley,
No.
Lynn Paquin for Betty Yee.
No.
Madam Chair, I have 2 yes votes, 1 by Margaret Brown, 1 by Jason Perez, 9 no votes for motion being made by Jason Perez, seconded by Margaret Brown regarding firearms.
Okay, thank you. So motion fails on the, the motion fails. And I guess I have a question for Matt at this point. Do we have to vote, since we voted down reinvesting, do we now have to affirmatively vote to divest? Is that how we have to do it, Mr. Jacobs?
To continue the divestments, yes.
Okay. So I need a motion.
Was that David's motion?
Yeah. Yeah, I'd move that we affirm.
Second.
On which we have to do one at a time.
Oh, do we? Can't.
Yes.
Well, I think that at this point, if you want to have an up or down vote on all 5, that's okay,
Yeah.
but you should specifically identify all 5 in the motion.
Okay, David.
Okay, I will move that we affirm all 5 of the active mandates on divestment, which include tobacco, firearms, Sudan, Iran, thermal coal, and maintain the status quo.
I've got a motion from David. Do I have a second?
Second.
Second from Rob. Go ahead, Pam and
Margaret Brown.
Now, I have a concern. I'm going to vote no on some and yes on the other. So.
Does that mean we have to redo the vote, Matt?
Well, you can either separate it out, or Ms. Brown can vote no because it's over-inclusive, and she can vote no on that basis.
Well, I don't want to vote no on Iran and Sudan. Oh, let's be clear about that.
All right. So, can we restate the motion one more time? Let's do the firearms and the David and tobacco separately from the other 3.
Okay, so I guess I'll have 2 motions. Does that work?
Yeah.
Okay, so my first motion is to affirm the active mandates for divestment of, well, no, not just, to affirm our divestment decision on tobacco and firearms.
Okay, and the second is still standing with Mr. Fechner?
Yes.
Okay, so it's been motioned by Mr. Miller, seconded by Mr. Fechner to affirm the divestment for tobacco and firearms. Pam, go ahead.
Okay, Margaret Brown.
No.
Rob Fechner.
Aye.
Henry Jones.
Aye.
Matthew Seha for Fiona Ma.
Aye.
Lisa Middleton.
Aye.
David Miller.
David.
Aye.
Stacy Oliveris. Had to go. Irene Ortega.
Aye.
Jason Perez.
No.
Ramon Rubalcaba.
Aye.
Shonda Wesley.
Aye.
Lynn Paquin for Betty Yee.
Aye.
Madam Chair, I have the motion being made by David Miller, seconded by Rob Fechner. I have 2 noes, one by Margaret Brown, one by Jason Perez, and 9 aye votes to affirm the divestment of firearms and tobacco.
I forgot to unmute. Thank you. The motion carries. So David, can you make the next motion, please?
Okay, the next motion is to affirm our divestment of Sudan, Iran, and thermal coal.
And seconded?
Second.
Second by Mr. Fechner. So it was motioned by Mr. Miller, seconded by Mr. Fechner. Pam, can you take the vote for me?
Sure. Margaret Brown?
Yes.
Rob Fechner?
Aye.
Henry Jones?
Aye.
Matthew Seha? Was that an aye?
Aye.
Thank you. Lisa Middleton?
Aye.
David Miller?
Aye.
Irene Ortega?
Aye.
Jason Perez?
No.
Ramon Rubalcaba?
Aye.
Shonda Wesley?
Aye.
Lynn Paquin for Betty Yee?
Aye.
Madam Chair, I have 10 ayes, 1 no made by Jason Perez. Motion made by David Miller, seconded by Rob Fechner on the affirming the divestment of, I believe, Sudan, and I didn't catch the other.
Sudan, Iran, and thermal coal.
Thank you.
Okay, so the motion carries. That's the end of action item 5A. So we're going to move on to summary of committee direction. Dan?
Thank you, Madam Chair. I have 4, I'm not sure they were all entirely direction, but I think they were the intent. So we'll start with, first of all, there was an article on pension obligation bonds that we will circulate to the board. We'll consider an information session on special purpose, on SPAC, special purpose vehicles. We will list, per Ms. Middleton's request, we will list all the places where we were asked to divest and instead are engaging. We'll come up with good documentation there. And then finally, we will come back to this committee with our plan on the 3 coal companies discussed within this calendar year. Once Samiso and his team, who are leading that body of work, get through proxy season, we'll look to come back sometime this calendar year.
Excellent. Thank you very much. That's what I remember. Thank you. So then I think we are at public comment. I believe Mr. Fox said we had 2 more commenters.
Madam Chair, yes, we have actually 3 callers now. The first caller is JJ Jelensik.
JJ Jelensik, beneficiary. The board may itself make any investments authorized by law or sell any security, obligation, or real property in which monies of the retirement fund are invested by an affirmative vote of at least 7 members of the board, or by the same affirmative vote, may from time to time adopt an investment resolution that shall contain detailed guidelines by which to designate those securities and real properties that are acceptable for purchase. With the resolution in effect, securities and real property may be purchased for investment by an officer or employee of the board designated by it for that purpose. Sales of securities may be consummated by the officer or employee under the conditions prescribed. Purchases and sales of securities shall be reported to the board on a monthly basis at its next regular meeting. Government Code Section 20191. Thank you for your time.
Okay, thank you. Mr. Fox, our next caller.
Madam Chair, next we have Monique Hernandez.
Hello, can you hear me?
Yes, we can.
Yes.
Okay, perfect. All right. My name is Monique Hernandez. I'm here to speak item number 11. I've worked at Riverside Community Hospital.
Can I stop you for a second? Can I stop you for a second?
Yep.
I'm sorry, you have an echo.
Yes.
So if you have us on someplace else, you might want to turn it down.
No, I don't have you on anywhere else.
Oh, that's better.
Maybe it's because my phone was on speaker. Is that better?
Yes, thank you.
Is that better?
Yes, thank you.
Okay, I'll start. So my name is Monique Hernandez. I'm here to speak about item number 11. I've worked for Riverside Community Hospital, which is an HCA hospital, for 13 years as a registered nurse. I continue to do the best care I possibly can for my patients and advocate for my colleagues and my profession. In the recent months, perhaps years, I have been pained by this realization. Patients are not getting the care they deserve at RCH due to short staffing. We have patients that go for days without being seen by their physician, patients waiting days for diagnostic or therapeutic procedures. Imagine your daughter, your 28-year-old daughter, waiting 2 days for a CAT scan while being in the hospital because our radiology department is so behind because they're short-staffed. Or imagine your husband is on a heparin drip, which is a blood thinner, to make sure that he doesn't have a blood clot after having a heart attack. This medication is dosed according to a certain lab that we have to draw, and this lab is time sensitive. So if this lab was due to be drawn at 9:30 and wasn't drawn until 3 p.m. because phlebotomy is so short-staffed, this is not okay. Over and over, I've attempted to address these issues and concerns, and over I'm thanked for identifying an issue only to see the same issue play out days later or weeks later, often with the same entities or departments. I do not know what happens when these issues are addressed, but I do know that the end product, namely patient care, has continued its downward trajectory. I have been hopeful in some big changes with the incoming, with us being a teaching hospital, with the G-Tower expansion, strengthening our union's presence. The addition of the Rapid Response Department would move the needle towards excellence. Tragically, there have been some things that can only be accomplished with real human resources, people. The people at RCH are what make it run, but there have been too few people for too long. The most difficult thing is that at some point we needed 50 more or more nurses, then it slid to 100, now 200, and who knows what the deficit is going to be after the dust of this pandemic settles. Vacant nursing positions are a cold comfort. We need to invest in retaining staff and not being a puppy mill for new nurses. You're bleeding money at this facility, training them only to see them go to safer, better staffed hospitals in a year. I want to see RCH succeed. I have put great effort toward that goal and seen my sincere efforts occasionally embraced, but more often trampled by naked economics, by disinterest, and by a lack of accountability. I think that there's where your success will lie. Someday, having the resources and the moral authority to raise the level of accountability for staff and administrators alike. With all due respect to every one of you on this board, you will eventually be a consumer of acute health care. You will, if you haven't already, need hospital services. What kind of care would you want rendered to yourself and to your loved ones? In my humble opinion, lack of investment in the people that actually make this entity operate is catastrophic to patient care. Thank you for your time.
Thank you very much. Mr. Fox, our next caller.
Yes, Madam Chair, our final caller is Mr. Michael Ring, SEIU.
Hi, good evening, members of the CalPERS Investment Committee. This is Michael Ring with the Service Employees International Union's Capital Stewardship Program. Thank you for taking my comments and the opportunity to speak with you today. Along with SEIU member and HCA worker Monique Hernandez, who you just heard from, I'm here to share some information with you about important investment-related issues at one of the country's largest healthcare corporations, HCA, which owns the hospital that Ms. Hernandez was referencing. Our team recently shared with your investment staff a series of publicly available reports and articles that document the potential risk of HCA's business practices to long-term investors like CalPERS. Some of the issues of possible concern to consider for further due diligence include HCA policies regarding billing, stock buybacks, taxation, public subsidies, lobbying, compensation, and the workforce management and safety issues that HCA workers have shared with us that have only become more acute during the COVID-19 pandemic. We believe concerns about these business practices are relevant to CalPERS due to your portfolio's exposure to HCA. We also believe that it impacts CalPERS and similar long-term investors more broadly, given that as one of the largest healthcare corporations in the United States, HCA sets a market standard in an industry critical to the overall functioning of our economy, an industry that impacts taxpayers, consumers, workers, and investors, including pension funds and their plan participants. We encourage your team to do its own due diligence with this information to assess the risk HCA's practices may present to the interests of CalPERS plan participants, who of course depend on the long-term healthy performance of the fund's investments. Thank you very much for the opportunity to speak with you today and for your work facilitating retirement security for all CalPERS participants.
Thank you. Mr. Fox, are there any other callers?
No, Madam Chair, that concludes your business for today.
Thank you so much. So then that concludes investment committee open session. We will adjourn, and what time are we starting tomorrow? I believe it's 9 a.m., correct? It's a yes. I got thumbs up from Rob. Okay. See you all tomorrow morning. Thank you very much.